In this episode, we talk about how a founder should negotiate a deal with a venture capitalist, how to structure a deal, and what to look out for during the negotiations.
Learn more about the do's and don'ts in venture capital.
Welcome to episode 5 of this podcast series, Venture Capital Deep Dive. In this podcast, we talk about everything a first-time founder needs to know about the why of a venture capital investor. This podcast is brought to you by B2V Ventures, a Switzerland-based venture capital fund established in 2000 and focused on early-stage startup investing. And I am Cédric, your host of this podcast and the founder of globaltechbooks.com, a video platform focused on insightful interviews with experts around startups, tech, and innovation. Make sure to check them both out. Alexander Stoeckel is a partner at B2V since 2012, board member since 2014, and is actively seeking the best entrepreneurs and most promising startups. You can reach him over LinkedIn and email. So in today's episodes, we want to talk about negotiations and deal structuring. So we discussed about the due diligence process, we discussed about the term sheet, and now you're sitting with the founders and you're negotiating. What are you exactly negotiating at this stage?
For the most part, we are negotiating valuation and then really terms and conditions of the investment, such as liquidation preference, vesting, anti-dilution protection, etc. As mentioned in the previous episode, it's important that the founder is somewhat familiar with term sheet terminology and the subtleties of term sheets. So therefore, the recommendation was also in the previous period to download a term sheet for yourself, discuss it within the team, have maybe some veteran investor proofread whatever you're drafting as your own term sheet, and then submit it to the VC.
Maybe you can elaborate a little bit the practicalities or like the situation. Like, we probably think a lot about Hollywood, about or Shark Tank, how like forth and back that goes. Is that like in a meeting? Is this over the phone? Is this more in person? How does a negotiation actually go down?
I think it's interesting that is my personal opinion, but I think that Europeans are less drawn towards negotiations of term sheets because they feel more comfortable in an amicable environment. So they would like to sit down and close the deal without much hassle, if you will. This can be an opportunity for entrepreneurs as well. So if you're really into negotiating, I would recommend that you just try to get the best out of it for your company. So don't shy away from arguing that this and this is important and questioning whether or not this or that is important, because you will find that the VC also gets drawn into the deal and at some point would like to close the deal and is likely to concede something that you previously thought would be impossible. On the other hand, the VC thinks that his or her influence on the company is as big as it gets before he signs the term sheet and especially before he signs the final contract. So therefore, whatever he wants to change within the company that is really important and substantial, he will try to change before he signs the contracts and invests in the company, because he knows that his influence on the company will be much lessened after he has signed the document.
So what are some of the, let's say, negotiation tactics of a VC? So imagine I'm an entrepreneur, I'm sitting here with you, and we are discussing the negotiations. What are you telling the entrepreneurs to have a certain effect on the deal terms?
So first of all, as a VC, I think for me, the big picture is important. I want to invest in this company. So at the end of the day, the result should be we get to a term sheet and we sign it and then we invest in the company. The second priority will be we should make sure that we can invest under terms that are favorable for us as investors. So the most important aspect would be valuation. However, if the deal is highly sought after, is very competitive, many people would like to invest in the deal, we will at some point concede higher valuations as well, just saying it's important that we get into this investment, right? So don't make a mistake by thinking at some point they will just walk away. Many of them will not walk away. They will pretend that they walk away, whereas in fact they would like to close the deal still. Therefore, valuation, you should have a good understanding of what you're looking at in terms of valuation. And if you want, I can elaborate a bit on that.
Well, we have a whole episode. Episode 6 will be all about valuation. But what I would like you to go on a little bit more about, like the actual negotiation itself. Like what is being said from a VC that like can make an entrepreneur think like, oh wow, like he's not going to invest at all, or like what are the things that you're saying that like might shy away the entrepreneurs?
The walkaway is really the most important measure and mean that you have as an investor. So you can threaten the entrepreneur to just walk away from the deal. That should at some point convince him to concede that this and this is still viable, right? But again, the VC themselves wouldn't be negotiating with you if they weren't interested in investing in your company. Be confident and strong enough to negotiate with the VC. He will also tell you that many of the aspects of the term sheet are not only for the investors, but in certain topics also for the founder team. So think, for example, about drag along. So the drag along clause enables minority shareholders to force majority shareholders or other important shareholders, for that matter, to sell their shares in the company and eventually bring the company to an exit. If you think about a scenario where we have maybe 3 founders and the company has developed well and there's a company offering to take over the company, the startup, then at some point maybe one of the founders feels that he doesn't want to sell, but the other 2 want to sell. So based on a drag along, they can force him or her to sell their shares as well. So this is not necessarily something that is only important for the investors, but could also be important for the founders and eventually the entire company.
The other side, like what is it that, let's say, can an entrepreneur say to really get like the VC out of the deal? Like what is a no-go? What can an entrepreneur say or should not say to really ruin the deal for him or her?
I think the way you conduct yourself during the negotiation process, that would be the main aspect. If you are too stubborn and not open to, if your arguments are not rational, etc., etc. But otherwise, I think it's fair game. Everything you can try to get done during the negotiation process is fair game. I think, again, in terms of valuation, there are 2 sides of the same coin, I think you're looking at in these negotiation processes. So there is a certain benefit for a high valuation, for example, to be negotiated by the founder, because then the dilution of his shareholding in the company is lower than it would be with a low valuation. However, high valuation in an early round of funding, for example, is also or can be sort of a burden in future rounds of funding, because in venture capital, the narrative will always be growing and increasing valuations. So if your valuation in the seed round has already been 10 million, for example, then it has to be at 15 in the next round, and that can be a problem. So therefore, also listen to the investors when they say, look, this might make sense to you right now, but this may become a problem in future rounds of funding, and consider this and that. This would be my argument, for example. And sometimes you find that the most experienced VCs are not really stubborn on their terms and conditions, but really try to get a deal done that is beneficial for all parties involved.
Now, when you look at, let's say, the deal structure, so you have like the negotiations and like you are talking about like how to structure a deal before you invest. What are some of the common types of deal structuring that you face with entrepreneurs?
So they have 2 general concepts of convertible loans and equity rounds. The main benefit of convertible loan would be that you don't have to negotiate the valuation, because it will be determined by the valuation that is decided upon in the next round of funding, and it's faster and easier to work with. So you can close your convertible loans on the run for a certain period of time. You don't have to find a certain closing date, for example. This can be very recommendable, especially in early rounds or in bridge rounds where you're in between things, for example. The equity rounds, on the other hand, come up with the more sophisticated term sheets, if you will, and they will deal with valuation and then certain terms and clauses that protect the investor from losing capital. That would be the main idea. The general standard for convertibles would be that you invest a certain amount and you are granted a certain interest rate, something on the order of 5 to 15%, depending on the investor, and a discount of 20% based on the valuation of the next round. If you're looking at equity, in early stage rounds, you're looking at something on the order of giving away 10 to 35% of the company, again, depending on the investor, the stage, etc., etc., but retaining as founders 65 to 80%, maybe 90% even, the shareholding within the founder team.
And when you take together, like the deal structuring and the negotiations, how do you manage? I mean, like many times, like the perception of the entrepreneurs is like, I need the money right now. So like there's a power of negotiations with the venture capital fund. How do you manage like all of these like different expectations, but also like the power that you have as like being the one that brings the capital, that brings the entrepreneur to the next level?
First of all, we want to invest in the company. We want to give them money because we believe in their business concept and we want them to prosper and strive for the next level, etc., etc. There's no no need to assume that we are motivated to let this fail for whatever reason. At the end of the day, if the negotiation process fails, we just lose money and time. So it's not in our interest. I think, on the other hand, you're looking at a complex game of interactions between the investor and the founder. If the founder signals that he is really running out of cash, that necessarily gives us a stronger position, because then we could eventually even dry him out. We can just wait until he runs out of cash and then impose whatever terms we feel most comfortable with. But then, in turn, this will mean that the relation between us and the founder would be very negative and not really helpful in terms of growing the company to the next level. So therefore, as an investor, you're trying to balance, if you will, your investment interest and how you conduct yourself in the negotiation process, and try to get through all the points that you find most important and interesting, and at the same time look at the overall structure. Is it still helpful for the next round and suitable for the next round of funding? Is there still enough incentive for the founders to work 12 hours per day in their startup, because at the end of the day they get a big chunk of cash from their equity shareholding, et cetera, et cetera. So I think this process to balance the negotiation process and get to a result that is really acceptable, I'd say, for both parties. In fact, I think that if both parties get up from the negotiation table and are somewhat displeased with the outcome, then maybe you are approaching a good outcome, because then every party has conceded this or that, and nobody is really, really happy, but both are content that this deal is done and that the investor is in, that the cash will be coming, and that they can take the company to the next level, etc.
Very good. Thank you so much for these insights. In the next episode, we will talk about how to value an early stage startup, how much equity to give up in a funding round, and the challenges of early stage startup valuation. Stay tuned for next episode.